let's also bring on board Tushar Pradhan, Chief Investment Officer with HSBC AMC. Tushar, good morning. Thank you for joining us. Tushar, 600 points on the Nifty. How exactly is the risk-reward ratio stacked up? Do you think markets at the current juncture are looking slightly frothy, or the upside has just started?
No, I think one has to look at it from a perspective of how long one looks at the markets. We have had a fairly significantly long bearish period in the markets, which have actually now come to about normal, I would say. Is this a new normal? Should we expect anything further from here? I think a lot depends on the direction of the economy from here. And all indications appear to be that your down cycle in the economy, which has lasted close to 3 years now, is at least bottoming out, if not going ahead from here. From a market's perspective, what happens is the markets actually do discount the development in the economy a little ahead of the time that the economy actually starts to work up. So if we are waiting for economic numbers to come by, if you're waiting for earnings number to come by, it actually might be looking at the wrong end of the picture. The markets actually do signal any sort of potential increase in the economy. However, these signals can also be wrong sometimes because they are largely based on expectation. So I think to give a very short answer to your question, I think we are looking at fair value at the moment. But as you know, fair value depending on what we knew about earnings, what we knew about the economy 6 months ago. If we think that there is going to be a significant change in the economy, in the corporate fundamentals overall, then who knows, this might not be fair value, it might still be a little less than fair value. So I would take the call only once we start to get a little more momentum built into the current rally.
Tushar, let's talk about industrials and economy-related stocks. Stocks like L&T, ICICI Bank, Ashok Leyland, they are up more than 40 to 50% from the recent lows. But the grain of truth here is that the new capex cycle has not started. Interest rates are still high, and earnings have not got upgraded. So, what is the excitement and hullabaloo all about?
Well, actually, there is, as you say, hope that what we have seen in the last 3 years is going to reverse in some way. The best way to play that is to actually look at the largest players in the market who will participate in any kind of economic revival. So as I mentioned before, the markets don't really wait for the economic revival to start and to see the numbers in print. It actually starts to discount what is likely to happen in the future in the prices today. So what we're seeing is really this phenomenon that the assumption is that at some point of time the economy will revive, the investment cycle, as you call it, will start to, the engine will start, and then who are the first ones to benefit from that? And so in this situation, it appears as if we actually have to price in the future at today's prices, and I think these prices are reflecting that expectation. So I would caution investors to say that, is this a fundamental value increase for the companies that we are talking about? I think this is basically putting in a price for future expectations at today's price.
Tushar, you know, you've earlier voiced your views on IT as to how the sectoral rotation has really begun, and IT seems like at the fag end of, you know, the fair value, and the valuations are looking a little bit toppish. We've seen a knee-jerk come in post the warning set out by Infosys as well as TCS management. Did you look at them as buying opportunities and piled on more of IT?
No, in fact, what we are looking in the markets, of course, is also a correction based on the strength of the rupee. So you have to remember that, yes, there is a fundamental robustness for the business of IT that is fueled by the economic strength displayed by the US, which is the largest target market for most of our IT companies. But going forward, you realize that part of the premium which was getting into the price was also because of the considerable depreciation in the currency. And as a result, margins were looking much richer than the actual base case year-on-year increase on a dollar level. What you're now seeing is that froth, which is the extra margin which was shown because of currency depreciation, is likely to kind of come off from here. So we're going to see some temperance in terms of the valuations there. But I've always maintained that one should look at the entire economy in a much more balanced state. So while there will be parts of the economy which will do well, there are certain companies which display a significant long-term robustness, and I would count IT companies within that. So while there would be gyrations depending on either a soft business outlook for a quarter or two or the currency. But I think the business proposition for why the IT companies will remain profitable for a long time continue to be strong. So I won't say knee-jerk as in saying, okay, now it's come off, so this is the time to get in. I think we are maintaining our positions in IT as well as some of the other interesting industrials sectors in the economy as well.
Take a look at Tata Motors DVR. That's up for a second day above its 50 DMA. It's giving you a very good breakout as we speak. And Adani Ports is the other one, which has been gaining up for a second day above its 20 DMA. That's where the stock price is. Adani Port holding up by about 1.5%. Let's see the price volume breakout chart for Adani Port. And Tata Motors DVR, of course, is the other one, which is holding out in trade right now. But Tushar, what about the other legs? You know, pharma, FMCG, along with IT, would you approach them with the same lens, that stay put for a long-term time frame while the near-term may look a little bit wobbly?
Yeah, I think the problem there is not about business fundamentals. The problem with pharma and FMCG is largely due to the excessive valuations. So yes, while this might be a great company, will the stock price of that company make you money? That's a different question. So nobody is denying the fact that FMCG is in a sweet spot in a demographically exciting country like India. We cannot foresee any significant drop in the volume and the pricing potential for most of the goods that it sells in India. However, what are these earnings trading at? So I had mentioned earlier also is that what really bothers us is about the fact that there is a cap to what these valuations can be priced at. So while we have seen pricing for some of these FMCG stocks continue from 30 times one-year forward earnings to 40 times, how much further from there is what the question I had asked at that time as well. And I think the reality of the market and the mean reversion that it shows will more or less indicate that there is going to be a significant tempering of expectations in terms of returns on stocks from here. But this is not any indication of how or if the quality of the company is any in question at all. So one has to kind of look at those two things in that perspective. So when one looks at the significantly lower valuations given to the industrials and the, let's say, the core part of the economy kind of stocks, they are at a significant discount. And if you look at the FMCG and the pharma sectors, they have been trading at a significant premium to the average for quite some time. And the average is not, I'm talking about the average of the market, but even their average valuations over the last 5 years or so. So I think this is where the mean reversion is likely to happen. So again, not making a comment whether these companies are any worse off today. It's just that the valuations are just too demanding.
On 16th of May, the election verdict will be much more complicated than what markets are betting on. As of now, forget 9 on 10, 10 on 10 market players are convinced that we will get a stable government and Modi will be the next PM.
Yeah, I think there is a grain of truth to your statement here, borrowing your own metaphor from some time back. There seems to be a fairly significant, let's say, agreement that there is going to be a scenario which is, more or less bought by all. And if there is a situation where the outcome is not as much as what we are expecting, obviously the markets are likely to correct. They're likely to get surprised as well. What I had spoken about earlier also is that I think this market for this entire year is likely to be like a roller coaster ride. So if you go up pretty fast very soon, as we are seeing in the last few weeks or so, get ready for a ride which will go the other way also. If there is some disappointment, some difference of opinion, some surprise which comes back, and it will make sure that the markets will ride the other way also. The reason why the roller coaster ride will continue for a while is that the basic on which the pricing is done, which is the earnings per share, that's been pretty weak for the last 3 years. So that's the reason why valuations is what will drive the direction of the market. Sentiment is what will drive the direction of the market. So till we establish that we are back into a pretty strong, robust earnings growth season, where we see the next 2 or 3 years of significant earnings rises depending on an economic cycle going up, till we get to that situation, the markets are likely to be volatile. So yes, I agree. I think once everyone's agreed to one point of view, my bet is always on the other side.
So For the moment, even though we are at a record high on the Sensex and on the Nifty, you are not of the view that a secular bull market has started. You are of the view that, look, there are a lot of concerns, there are a lot of wrinkles, and the fly in the ointment could be May the 16th.
That is just one. All I'm saying is that even if we do have the government that everybody is thinking of will get elected, the second phase is what are its economics policies? What are the kind of things that it is able to do? At the moment, it's all in the promise range, but the transformation of that into an actual functioning economic agenda and then eventually execution, which will be far down the line, maybe even 1 or 2 years from now, that all remains to be seen. So nothing is done and dusted just because you have a verdict one way or the other.
Tushar, what is it that you're liking from these high beta spaces, real estate, infrastructure, or for that matter, a lot of people are now talking about, a turnaround in cement as well. Anything that you like?
Well, I think we have been fairly positive across most of the industrials names, but I won't be specific about names. But the fact is that if you look at quality across these sectors, there are plenty of companies which you don't really have to rely on an economic cycle turning around. What you have is very high quality businesses which are just being discounted because of the way the state of the economy is. But at any point of time, the resilience of these businesses, the vital nature of their contribution to our economy. Just take power, for example. If you believe that we don't live in a power shortage environment, I think you need to wake up and smell the coffee. So whether there is an elected government which is either for power reform or not, what is very clear is that we have a shortage of power. So at any point of time, at some point of time, these businesses will have reason to kind of have sales growth. That is the crying need of the hour. So I think what we're missing is that the sentiment sometimes drives the values of these companies significantly lower than what they should be trading at. And I think a lot of these companies are trading at that value. So without taking a call whether the economics or the elections are going to drive the valuations, all I'm saying is that these businesses are high quality, they have large market share in the spaces that they operate in, and they're absolutely needed as a very vital part of our economic growth, whether you have an election or not.
What is your tilt? Power utilities, power machinery, power financiers?
I think the scope there is a little confusing, because if you look at the power distribution scenario, it continues to be as confusing as it was 2 years ago. There's not been much progress on reform there. But if you look at power manufacturers, if you look at component manufacturers, if you look at all of these sectors which have just been kind of discounted because there was no fresh ordering, let me also remind you that the existing order books going forward into the 18th or the 2-year period, going forward 18 months to 2 years, they still have very robust order books. The confusion was whether they'll be able to finance the project, whether the project will get off the ground, so on and so forth. So it's not a lack of demand there, it is just the ability to finance, the ability for the government to make these things possible, land acquisition for that matter, or so many things for which these projects are being stalled. So at some point of time, as and when these things occur, and even if we realize that a lot of clearances have actually happened even now as we speak, that is the impetus which is required for these companies to start doing well, to start showing the profits on a sustainable basis. So I think it's not to do with a very broad brush to say should we select financiers or project implementers or equipment manufacturers. I think if you focus on the more basic aspect of the entire power business, I think you'll identify the winners yourself.